This is Tomoyuki Misumi of Phillip Securities Japan. I'm the research analyst for the Japanese stock and also for US stock. And for Singapore investor, I will provide some useful information and some sort of perspective and review of the Japanese market and some pick stocks. Okay, let's start with the so this is toward economic rationale as the theme of this presentation, and it's continuing from the last presentation of the third quarter 2023. Yeah, Japan is one of the successful advanced economy in the world, but there's some sort of major reform and fine-tuning required to be a true capitalism company, true capitalism market. Let's start on from the politics of the Japan. The current Kishida government and the Liberal Democratic Party (LDP) lose popularity. So this is NHK National Form Testing Company taking consensus of the Kishida government as approval ratios. There, from the inauguration of the 2022, there's a 49% of the approval, but it's declining. So LDP approval is also declining. So this is unstable political background in the Kishida government. So what's the important thing is what the cause is the trouble in government digitalization project. Well, Japanese government distributes some newly digitalized identification card for people, and it links to the some insurance card for insurance card, but there's some discrepancy in the system of fine raters. So this turned out to be disapproval to the Kishida government. But the most hidden and important theme is that no advancement in tax reform. Japan is more than doubling the fiscal deficit of the GDP, and we need a tax reform or the social security reform for more stable government funding. So, and second thing is Fukushima treated water dehydration. We call it a treated water instead of the treated water dehydration. This turned out to be a China import ban for Japanese marine products. But the Japanese people is willing to be supportive for the nuclear plant, and this water dehydration is also supported by many of Japanese people. So the most and also good news is that the Kansai Denryoku, the electricity provider of the Japanese Western region, regenerate all nuclear power plants in Western region Japan. In this region, there's a TSMC semiconductor factory is rising in this region. So it's also tailwind for Japanese semiconductor industries. Next issue is the BOJ monetary policy review. So there's some layers of the structure of the BOJ monetary policy. It's in overall framework, it's still in the monetary easing, but there's some traditional layer and untraditional layer of the BOJ policy. The layer first is legacy of core BOJ, yield curve control, and negative interest rate. So this is untraditional layers. The weather is expected to abandon this first layer system. The second is quantitative easing, large purchase of ETF, and then untraditional, this is untraditional part of the quantitative easing, and large purchase of JGB, or Japan government bond, is also expected. The third layer is zero interest rate policy. it's BOJ basic discount rate is a policy rate that BOJ is setting for the all banking system is almost dividing into the near zero rates from the for almost 20 almost 2000s and slightly up, but it's then back to the near zero rates. Okay, so the third layer, this is difficult to remove for fiscal reason. So if interest rate rises, some interest burden on the Japanese government is soared, so it's difficult to remove. So removal of overlayer is possible if tax reform and consolidation of Social Security are politically determined. But I assume that the Kista government cannot do that because its political support is declining, and we have to expect to the next government. Okay, so what's the issue of political monetary policy is that if the monetary policy is really effective so far or not. This is the plotting the monthly average balance of the yearly growth of the monthly average balance of the money stock and monetary base. The monetary base, the year line, is the current account balance of the bank, the BOJ bank account from bank. It means that the BOJ purchased JGB from the bank, from the major bank. So its money is deposited at the BOJ current account. So if BOJ purchased JGB abroad, its year one is increasing. The money stock is money circulating around the economy. That the banking, how much banks are circulating this money. So you can see that the monetary base is soaring so much on and peaked at 2024, 2040s, and the decline and the growth rate is declining from this at this time, and YCC is in the middle of this tendency. So further assume that there's such a continuing extreme aging is impossible to continue. So new policy framework is entered. This was the YCC, and the weather is expected to abandon this policy, but the impact is unmeasured if he officially say that we abandon YCC regime. So what the Fed and the BOJ different from? Now, Federal Reserve Bank is returned to rule-based monetary policy. They saying that seeking for our star is natural policy rate, natural interest rate. It means that it's a natural rate that if the no policy intervention, and then natural rate is determined by the money demand and money supply of the market economy. So, and the central bank should seek for the star rate policy so that the central bank with less affect the market economy. So it's the Fed already abandoned the capital reasoning. It's also in the interest rate regime. and citing the PC index, it's a coincident indicator. Let's turn to Bank of Japan. It's still in a discretionary policy. And so quantitative easing regime is still continuing. They're also citing the core CPI. It's a coincident indicator, but care more about the GDP gap and GDP deflator. It is a lagging indicator. It's completely different from the FRB. Okay. So the currency perspective is that if interest rate holds among JPY, if interest rate parity holds among Japanese yen, US dollar, financial position of central bank alone may not be the problem. But the interest rate matters. So JPY USD currency rate widened if the countermeasure inflation was taken by BOJ. And US inverted yield curve will revert and normalize while short rates keep constant. It means that it's still crossing. US yield curve is still inverted. The total rate is higher than the longer yield. But if it's a normalized, the long-term interest rate gap between Japanese yield curve and the US yield curve is widened. So in the term interest rate for term structure rates, in the term structure of interest rates, yield difference is widened, and the US-Japanese interest rate gap is increased in terms in any term structure of interest. So from this perspective, I see that Japanese explanation about how Japanese policy is far from the rational perspective, but I hope that it will return to be a rational phase. So I also see that some Japanese companies have some irrational aspect. The unsophisticated sophisticated financial policy with holding so much retained earnings and excess capital, raising excess capital for protective policy. So our stock picking policy is like that, open and accountable. The company with English disclosure, a profit loss statement, balance sheet and cash flow statement, and business description are all available, at least available, and earnings are simultaneously available. It's very important because some disclosure are issued at first in Japanese and next day in English. It's very bad inefficient system. So stock picked by me is all earnings reported as simultaneously in both English and Japanese. In the investable scale and affordable price, minimum market cap with 30 billion Japanese yen is that I see that it's a mid-rise cap, so that you can see that any coverage analyst report, and also large enough liquidity so that you can match the selling and match the prices and for buy and sell in any time. And also unit stock under 1 million Japanese yen. There's a unit stock system that if you want to purchase a Japanese stock, you have to purchase at 100 stocks at minimum. This is really bad system. You have to, whatever you want to purchase, as your purchase cost is 100 times its price. And we also see the production, the operating efficiency, minimum gross margin, gross profit margin of 30%, also minimum operating margin of 20%. This is rational choice that the company can meet enough shareholder returns. hedging market risk is ideal, less than 1.0 beta. Cutoff, sorry, I missed it to type in. I see that the minimum of 1.2 cutoff beta, but I violate in extension of the portfolio company choices. Economic value added is also important. WACC spread over 1.0%. ROIC minus WACC is economic value added. And also it's synonymous of the return on equity, residual income. You know that ROE minus equity cost of capital is the value added for return to belongs to the shareholders, but the ROIC is the value added belongs to the both equity holder and bond holders. The logic behind this disclosure will eliminate price inefficiency, and the financial policy, and also assume that the financial policy are not overly sophisticated in Japanese company. So measure value added at all stakeholder is fair choices to measure the potential profitable companies. So the construction rule is divided 5 million JPY at initial cost. This is a portfolio cost, so that individual investor can purchase for us at affordable prices. Allocation is discretionary, but almost equal amount. And leverage, no leverage and short sales. Rebalances, no rebalances. You don't care about want to purchase and selling, to keeping the risk, constant risk. So because my purchase was almost minimum one. The diversification is being balanced approach. Investments, no dividend reinvestment. So last portfolio is like that. ZOZO, Chugai, Nintendo, USS, Tokyo Seimitsu, Zenko Kosho, Sankyo, Kakaku.com. The stock peaked by last third quarter presentation. So, but this performance not very good. Majority of stock declined in its price. You see that the stock end price is like a minus 7.2% decline. ZOZO. Chugai Pharma is fair, 11.5%, good performance. Nintendo is minus 1.4%. USS is fairly 3.0%. Radius. Tokyo Semis is minus 6.0%. Zenko Kosho is minus 2.0%. Sankyo is very strong performance, is 17.1%. And Kakaku.com is minus 25.7%. It was performers. But from diversification works, it ends up in the 0.9% price return. It's almost no few losses. And you also can gain the ZOZO dividend from ZOZO. It's turned out to be minus 0.7% declines. So I have to rethinking about the strategic portfolio. But before that, we seeing the individual stocks perspective and reviewing these companies. ZOZO is one of the biggest apparel shopping website provider and platform for all ages and price ranges, from reasonable to luxury. Also provides second use purchase service and also offer the credit for consumers for facilitating new purchases. It's very profitable company, though the decline, the quarterly price decline, I think that it's temporal. Let's move on. Let's see in the price performance. The target price net income is also expected to increase, and its revenue is also increasing. The dividend payout and dividend yield is also fair, and prices looks stable so far. let's see the multiple and return ratio as the ROE of 48.1% target level is really prospective. Currently 60.1% ROE is really mesmerizing. Let's move on to the DuPont decomposition. It's a technique, analytical technique that the ROE is result from what kind of the composition of the profitable statement or some asset turnover or some degree of leverage. Let's see, it's a net income divided by the operating margin. It's very 70% of operating margin. Net income explain the operating margin, and also gross margin is 93.4%. It's very efficient. I also see that the revenue divided by average asset of each fiscal year is more than 1.0, and asset and equity divided is more than leverage is higher than 2.0. So it's a very ideal company, and this is some kind of the right house for picking the stocks. But it's so, this kind of company is so rare. So even if the quarterly result is not good, I think that you should keep holding if you have. Let's all move on to 2A Farm. Sorry, I don't give it some written description. This is some major provider of antibiotics. This is profitable, and dividend is also fair, but dividend rate is over 2.3%. It's also fair, and the price also increasing. And you see to the DuPont decomposition, average asset living under asset turnover is less than 1.0. It's asset heavy and not efficient in terms of the revenue versus asset. And asset versus equity is less than 2.0 or 1.3%. Some sort of leverage is effective, but not sufficient. But ROE 28.7% is really it's still attractive for Japanese investors. But perspective is not so good because some for writer I present that it's a targeted price is decreasing from current level. And let's move on to, this is Nintendo. This is the major console provider gaining platform for already stand proficiency. Proficiency means that how much you invest in playing the games. You can say if you are in the sort of right users, you don't have to invest a lot much or purchasing the expensive gaming tower PC like Alienware of the Dell. It's also some IP content of the Mario, Zelda, Pokemon, and also new game console release. It's potential surprise. It's also a negative news that this next quarter of the 2023, Nintendo will not release any new console. The Tokyo Game Show of the last month is the possible opportunity that if the Nintendo release the new console, but it's not released. Let's move on to its performance. Its revenue is expected to decline, and the net income is also expected to decline. And this is Bloomberg consensus. But also move on to the DuPont decomposition. Yeah, net income over operating income is, and also gross profit margin is so efficient. but time to the asset turnover is not inefficient. Asset and equity degree of leverage is also in a fair level. Strong earning efficiency, but asset turnover is low. No interest-bearing debt except the financial risk is utilized. No such more sophisticated financial policy like Apple. I think that Nintendo can potentially do some kind of shareholder return policy like Apple, because it's a major provider of the. I think that the Nintendo game console is like a free smartphone device for children, because then parents don't want to give their children a smartphone because there's some harmful contents in internet. So if your parents want to control the children, they give you a Nintendo, and so game console will never it's long-lasting products for now. Someone say that the game console is completely deleted by the smartphones, but actually the game console is continuing because there's so many choices for the smartphone and game tower PC, but you can pick the very small choice from small choices, and also only care about what the software you want to play. So USS is also major provider of the car auction platform and existing suppliers of second car prices. Shortage cost car semiconductor chip and new car supply can be a tailwind for this company. And actually what's happening now is like that there's a shortage of the computer chip for the car, and there's also the second used car prices of second car increasing in Japan, and also car supply can be in the shortage. So let's move on to there's assets there is also strong efficiency in the earnings, but also not efficient in the asset turnover, and the degree of leverage is fair. Tokyo Semi, sorry for no description, but it's also a major provider of the semiconductor production devices. Let's move on to this is the profit loss statement of its dividend yield is really fair, though even though some sort of the growth stocks. And net income is also increasing from the March 2021 to from the March 2023. It's expected to decline the target level, but you see that a lot of semiconductor demand will can be a tough surprise for the stock prices. And also, let's see to the DuPont decomposition. The asset turnover is fair because it is a lot of the capital investment is required, and and degree of leverage is still fair, but earning efficiency is very good. So let's move on to the Zenko Kosho. This is a major housing loan guarantor at non-bank entity. So there is a non-bank, it's a non-bank entity. They can freely seeking the profit opportunities. So let's see the dividend. It's the earnings is increasing and expected increase, and the net operating margin is so efficient operating. It is no gross margin in for business model. There's no gross profit margins. Assets heavy. You see the smallest, is the lowest asset turnover, but asset and equity is big, more than 2.0. So the leverage are utilized. Sankyo, this is major supplier of slot machine and pachinko. It's called pachinko for amusement facility. This kind of the officially permitted gambles. So its demand is strongly dependent on consumer habit. It's kind of indulgence. Utilizing Japanese animation character of both old and new ones. If some animation is released and enjoyed so much for public, and their characters and stories are utilized in this kind of amusement machine. This is major monetization of Japanese animation contents. So the Sankyo is having this strong position for suppliers of the Japanese animations. So dividend policy is dividend is fair, and gross margin is also fair, and operating margin is also efficient. And it's also increasing from March 2030. It's from low level to higher gross margin level. So the stock price is also increasing. So we see that from net income plus operating income suggested disposal of asset. You see that the net income divided by operating profit in over 100. It means that the operating profit is bigger than net income. There is some disposal, and net income is bigger than operating profit. So it seems that it's some irregular profit item is incorporated in net income, and it's not accrual. It's not the recurring items of the profit. So, and the average asset turnover is not attractive, and degree of leverage is not enough. So, asset disposal is good financial practice, but asset itself is still increasing for compounding retained earnings. It's some good policy is it's good policy versus bad policies. Kag.com is a major search platform for a platform manager for eating and shopping. If you want to cite some of the good device, some restaurant, you will see the Tabelog for seeking Japanese good restaurant. And share is strong, but vulnerable to consumer habit change. And new strategy for taking demand from passenger is still uncertain. This is bad thing. That's why the Kag.com is decreasing in quarterly prices. So the revenue and gross operating margin is enough strong, but let's move on to the. It's a ROE is very nice, and ROIC is still good condition, but the perspective is not good. So let's move on to portfolio Gen 1 perspective. This is generation 1 portfolio, and if you're still continuing to do holding that, at the median of the portfolio value at beginning from if you purchase at October 3rd prices, the beginning price is 3.9 million yen, and any portfolio value from next 12 months is turned out to be the 4.3 million Japanese yen, and expected dividend is like that, and you gain the total 4.4 million yen, and price return is 9.3%, total return is 11.8%. It's attractive, but from now, and this perspective is price target is like that. This is a Bloomberg price target, and this is the definitive target median of the definitive target price. Is a median price of the coverage analyst perspective. And you see that I choose the lower of the Bloomberg target price and Refinitiv price target. So the median price return is like that. Sankyo is not good. And I see that the USS is not attractive price returns. The Chugai farm is also less attractive price returns. Cap.com is really good price return, but you see that too. If I taking lower of them, USA is still 2.0 and Chugai farm is 0.4%. I see that some of them were omitted from the portfolios. Let's move on to the. We also plan to consider incorporating the semiconductor industries. Japanese semiconductor industry is strong in devices and instruments, also components and materials. Sorry, I missed that. The chip maker is currently in three categories: IDM, this and Fabric and Fabless. Fabless is like NVIDIA and advanced micro devices and synopsis. And chip design is IP vendor like ARM, and EDA vendor is like synopsis. And production facility, foundry is like TSMC, and also Intel work as a foundries. And some chip maker, major chip maker is moved to the some Korean Samsung or like that. And Japanese company is currently strong in the devices and instruments for production, testing, and delivery, and components like minimum instruments and materials. And the plant, this is coating for making some sputtering and coating for the silicon chip, and gas and chemical and purified water used for productions. And semiconductor industry, seeing the semiconductor industry, screening condition is same: IR, open and accountable, self-standing quality, efficiency, market cap, scale, value added is also required. ROIC spread more than 5.0%. Beta less than 1.0 is not mandatory, but ideally the diversification at least works. Less than 1 million Japanese yen is consideration, but do not stick to it. Qualitative condition is the company relating to TSMC. TSMC is currently constructing and preparing for working of the Kumamoto factories, or namely called the JSMC. As an advanced semicon of the 5 nanometer nodes or tinier nodes rated is ideal. But if you should consider these kind of advanced semiconductors, you should consider possible risk that more stricter export ban by US might be enforced. Screening result is that Tokyo Summit is still our portfolios. Olympus is also a major player with ROIC spread is fair. And Disco, this is the grinder of the polishing the silicon wafers. This is a major supplier of the silicon chip. Yamaha Electronics, Advantest, Cinco Electronics, and Tokyo Electron Textiles, and Razortech. Sorry, I missed some. CS Chemical is also one of them. Sorry, I missed that. And I present later. Disco, Tokyo Electron, Razortech are major players of advanced micro semiconductor industry. Share of the Razortech, share means that it's not shareholding. It means that the Razortech product is almost 100 global share as related to ASML, EUV lithography. This is advanced techniques for tinier nodes for the silicon chip. If the price affordability is really bottleneck, Razortech is more than 1.3 million Japanese yen for initial investment. And Toy Electron is like that. And Disco is also like that. So let's move on to the creating portfolio generation 2. 5 million budget is still considered because this is still expensive. If you are affordable for 10 million Japanese yen, it must be good consideration. So target price, beginning of the consensus or definitive median price, if it exceeds negative or single digit return, it will be eliminated. Elimination, Chugai Farm, Tokyo Seimitsu, Sankyo,科学.com. Addition is Olympus, Capcom, plus Alpha Consulting, Shingetsu Chemical, Advantest. Third consideration is that the Nintendo and Capcom are both at the same amusement sector, but there's a low correlations. Tokyo Seimitsu is still prospective stock, but expensive, more than 70,000 yen at unit stock unit cost. Adding Advantage on Shingetsu Chemical almost equivalent cost, or it's so if you purchase these two costs, getting more diversification perspective.科学.com is still good at financial performance, but the major drag of last quarter, so lack of growth strategy is also crucial. Sankyo's growth is driven by its asset disposal, but its continuing protective financial policy. Disposal of retained earnings is still problems. So our adding perspective, our newly added stocks. This is major supplier of medical instrument, also supply the flat panel display production and testing devices for FPD, for semiconductor industries. Incorporating both medical sector and semiconductor sector growth. You mean that I see that the gross margin is fair, but the operating margin is nearly cut-off ratio, and diluted EPS and dividend yield is not so good, but there's some qualitative perspective for incorporating both medical sector and semiconductor growth. ROE is really fair, very good, 24.9%. ROE bigger than ROIC is proportionally ideal for better shareholder returns. So seeing the first decomposition, the leverage is asset heavy is really crucial, but it's fair level. And asset and equity degree of leverage is very attractive. So it turned out to be attractive return on equities. Capcom, do you know that it's a games provider like Street Fighter, Biohazard? So it's have a strong intellectual property characters, free of console sales risk compared to Nintendo. How dividend payout at current 86%, it's really attractive with 2% dividend yield. It's very volatile, but it's really low correlation between Nintendos. I'll show you next time. I'll show you next, but similar DuPont decomposition structure like Nintendo, highly efficient earnings, but poor capital structures. Alpha Consulting, this is new listed IT consulting company at 2021, and with first growth and strengths in big data. Potential major player of data center generative AI and data center implementations. For the Alpha Consulting, its financial performance, earning performance is very good. Gross margin is more than 50%, and also operating margin is more than 30%, and its dividend is continuing from the initiation of the listing. Dividend yield is low, but it's particular for the growth stock. DuPont decomposition suggests that the nearly ideal financial policy, you see that the asset turnover is more than 1.0, and equity asset and equity degree of leverage is more than 1. It's fair. So, and ROE bigger than ROIC, this suggesting the leverage is effective. sorry, this is about CES chemical. Sorry, this title is not different. So the CES chemical is the major supplier of silicon wafers. Its comparable company is Sumco, and so the CES and Sumco is the first and second largest silicon wafer providers. Silicon wafer is not counted as export product to China. It's really cross-related to the advanced semiconductor, but the material itself is not the direct contribution to 7nm node chips. Its financial performance is really good. And next one is advanced test. It's a decline. It's one of the export price company of the semiconductor devices, and the major competitor is the Applied Materials in the US. So the perspective is still uncertain about compared to the Lasertech. If you afford money to purchase a Lasertech, I recommend you to purchase the Lasertech, but its financial performance is really very good. Advantage is the good gross margin, gross operating and good operating margins, and also in a different incorporation, the turnover is nearly 1.0, and the asset turnover degree leverage is almost bigger than 1.0 and 1.5, and the return on equity is very good, and ROIC is also good. So portfolio general perspective is that the portfolio beginning at the 4.2 million at first at the October sales prices, with the unit stock portfolio value beginning of the stock is almost the equal amount. So the Olympus is 300 million unit stock, and total is 200 million stock, 200 stocks, and holding utilizing the medium or the medium target price, getting this kind of the price returns. Portfolio return is 4.9 million, and the expected dividend is like that. So you can gain the almost 1 million Japanese yen plus. So this is the price return structure of the return metrics of the highest return, median return, lowest return, and Bloomberg median target consensus target return is this kind of. So the advantage is some negative one, but the price target, median price target is definitive median target is really good. Almost all the things are nearly over the 10% price returns. And for diversification, actually, you can see that most of the stock are almost uncorrelated, except that the advantage on CES chemical is 0.6 correlation, but it's still low. And you can portfolio Gen 1, but portfolio Generation 2, about topics perspective. Topics for 5-year average return is 5.0%, and it's one sigma minus 1 sigma is like that, and it's annualized risk 11.8%. Portfolio Gen 1 is 35% highest return. If the old stock are at the strong increase at the most strongest targeting price, it's unusual. It's almost unrealistic. But its median is 9.3%, and its portfolio Gen 2 is more better than that. It's 16.48%, and its risk is bigger than the Generation 1. It's 70.70%, and the sharp ratio comparison is that portfolio Gen 2 is better than portfolio Gen 1 in the highest price, the highest optimistic scenarios. And normal even in the normal scenario, it's better than the portfolio generation 1. And the pessimistic scenario is better than Sharpe ratio topics. And so at least in the perspective, I gained a contract better portfolio, but the portfolio generation 1 is still lower risk perspective. So I'm sorry for not preparing the written description or concluding remarks. You can see that the Japanese company is still some inefficient part in the balance sheets. So, but there is some potential opportunity for surprise gain. And if the investor require a lot of more and more to the efficiency, increase of the efficiency, the Japanese company is more reaches to the US stock, US companies. So Nintendo is one of the potential companies like that. Okay, please look closely checking the Japanese company and Japanese market transition and be careful about this. Thanks so much. Let's move on to the questions.